You can design the most advanced artificial intelligence data center in the world. You can secure the land, you can buy the graphics processing units, you can install the liquid cooling systems, and you can even get your hands on the heavy electrical equipment we talked about in our last episode. But eventually, you run into the fundamental laws of physics and thermodynamics. All of that infrastructure requires electricity, and not just any electricity. It requires baseload power, power that does not stop when the sun goes down, and power that does not stop when the wind stops blowing. For the technology giants driving this build-out, the clean 24/7 answer they all want is nuclear. But here is the catch that the market is just beginning to fully digest. You cannot run a nuclear reactor without fuel. That fuel is uranium, and the Western world is structurally short of it.
Welcome back to the Working Thesis. Over the past 5 episodes, we have walked down the AI power chain. We started with the chips, moved to the servers, examined the cooling, analyzed the transformers, and looked at the heavy power generation equipment. Today, we are hitting the bedrock. We are looking at the literal, physical input that makes the nuclear baseload equation possible. We are looking at Cameco, the premier Western producer of uranium, and the bottleneck at the very bottom of the entire AI power chain.
Quick, honest note before we dig in. This is just two curious people thinking out loud, for learning and for fun. It's not investment advice and never a buy or sell call, so always do your own homework. Before we dig into the fundamental story of the fuel market, we need to address why Cameco showed up on the screen right now. If you've been following this series, you know that many of the companies in the electrical equipment and cooling space have been trading very near their all-time highs. They have been highly elevated, riding the wave of immediate data center build-out enthusiasm. Cameco showed up on our screen with a very different setup.
Exactly. Cameco flagged on the screen recently as deeply oversold. It was sitting roughly 29% below its recent high, registering a significantly low RSI. It triggered as an oversold and turning candidate on our read. Now, as we always say, we keep the specific mechanical details of that methodology in a separate explainer video, so we will keep it light here. But the core point is that this is a completely different entry condition compared to the high-flying shovel sellers. However, we also have to recognize that Cameco is not a quick bounce candidate. This is a long runway fuel supply core story tied to a very specific commodity cycle.
Let us contextualize exactly where uranium sits in this infrastructure supercycle. Think about the arc we have traced. The hyperscalers demand computational power. That requires server racks. The racks generate immense heat, requiring advanced cooling and massive power draw. That power draw requires step-down transformers to handle the voltage, which requires a robust electrical grid. To feed that grid, you need heavy turbines and power generators. But every single one of those upstream investments is entirely useless if there is nothing to burn or split inside the power plant.
It is the ultimate physical constraint. We spend so much time analyzing software margins, silicon architecture, and data center cooling efficiency that it is easy to forget the entire digital revolution relies on pulling specific rocks out of the ground. Uranium is the physical input beneath the nuclear baseload. Without it, the clean energy equation for artificial intelligence simply breaks down. And because Cameco is currently trading deep off its highs, it presents a fascinating contrast to the rest of the AI infrastructure trade. The market has heavily rewarded the trusted shovels, the equipment makers and cooling providers, keeping them near their highs. But the actual fuel providers have been caught in a much more volatile, commodity-driven downdraft, creating this distinct divergence in the chain.
So, what is Cameco? At its core, Cameco is one of the Western world's premier uranium producers. Based in Saskatchewan, Canada, it operates some of the highest-grade uranium mines on the planet, specifically the McArthur River and Cigar Lake operations. When we talk about Western energy security in the nuclear space, we are invariably talking about Cameco. They provide the raw material that ultimately becomes the fuel assemblies loaded into commercial nuclear reactors globally.
Let us look at the scale of their operations based on their filings and consensus estimates. Looking ahead, Cameco's management has guided for 2026 production of roughly 19.5 to 21.5 million pounds of uranium. In terms of deliveries, Because production and deliveries are not always perfectly synced due to inventory management and contracting, they are guiding for 29 to 32 million pounds. And crucially, management anticipates realized prices around 85 to 89 Canadian dollars a pound for those deliveries.
The financial translation of those physical pounds is significant. If we look at the first quarter of 2026, the company showed net income of approximately $131 million and adjusted EBITDA sitting around $509 million. This is a business generating substantial cash flow when uranium prices are healthy, operating at a scale that very few Western mining entities can match. They are not an explorer hoping to find a deposit. They are a Tier 1 producer executing on contracted deliveries right now.
But if Cameco were just a mining company, the story would simply be a pure-play commodity thesis. What makes Cameco uniquely positioned in this power chain is what we call the Westinghouse moat. Cameco owns about 49% of Westinghouse Electric Company, operating alongside Brookfield, which owns the remainder. This is a massive differentiator. Westinghouse is one of the most important names in global nuclear technology.
This partnership structurally links the entire chain. Cameco now has a footprint that extends from the uranium mine to the fuel manufacturing process, all the way to the reactor technology itself. Westinghouse is the designer of the AP1000 reactor, which is the foundational technology for the large-scale nuclear new-build programs happening in the United States and abroad. Furthermore, Westinghouse is deeply involved in the development of small modular reactors, or SMRs, which are viewed as the next generation of scalable nuclear power.
The financial contribution of this vertical integration is substantial. According to consensus and filings, Westinghouse is expected to add roughly $370 to $430 million of EBITDA to Cameco's profile in 2026. This means Cameco captures value not just when the raw uranium is pulled from the ground, but when the fuel is fabricated, when the reactor is serviced, and when new reactor technologies are licensed and built. Almost no one else in the global market spans both the foundational fuel supply and the cutting-edge reactor technology. It is a genuine, durable moat.
So, we understand the company and its structural advantages. Now we need to understand the demand driver, which brings us right back to artificial intelligence. For years, the narrative was that data centers would run on wind and solar. But as the sheer megawatt requirements for AI training clusters have exploded, the hyperscalers have run into the intermittency wall. You cannot run a billion-dollar AI training run on power that fluctuates when the weather changes. Nuclear is emerging as the only viable, clean, always-on baseload answer.
We are seeing this transition happen in real time. Major technology companies and hyperscalers are actively signing nuclear power purchase agreements. They are co-locating data centers directly adjacent to existing nuclear plants to secure power behind the meter. They are investing heavily in the backing and commercialization of small modular reactors. Globally, the nuclear renaissance is accelerating. There are roughly 75 reactors currently under construction worldwide, with more than 120 additional reactors planned.
And this massive expansion in demand is colliding with a severe geopolitical constraint on supply. Following the invasion of Ukraine, Western nations have moved to place sanctions and restrictions on Russian uranium and enrichment services. Russia historically held a massive share of the global enrichment capacity. By removing that supply from the Western utility contracting pool, demand is forcefully tilted towards secure, Western supply chains. This combination of exploding AI baseload requirements and the geopolitical fracturing of supply creates a brand new, structural pillar of demand operating underneath the uranium market.
This structural shift is clearly reflected in the price backdrop of the commodity itself. When we look at the uranium market, we have to look at two distinct pricing mechanisms: the spot market and the long-term contracting market. Currently, uranium spot prices are sitting around $85 a pound. The spot market can be notoriously thin and volatile, often driven by financial players and near-term inventory shuffling.
But the real health of the market is seen in the long-term utility contracts. Those term contracts are currently running higher than the spot price, sitting roughly in the $100 to $115 per pound range. Why would utilities pay a premium over the spot market? Because the paradigm has shifted. For a decade after Fukushima, utilities were squeezing the last dollar out of producers, knowing supply was abundant. Today, utilities prize security of supply above all else. They are willing to pay a premium to guarantee that they will have the fuel required to keep their reactors running through 2028, 2030, and beyond.
It is a genuinely tightening fuel market. The structural deficits are real, and the secondary supplies that kept the market depressed for years have largely been drawn down. Because of this dynamic, some analysts across the street see uranium climbing further from here, arguing that the incentive price required to bring complex, new greenfield mines online is still higher than the current spot price.
Of course, Cameco does not operate in a vacuum. To understand their position, we have to look at the rivals. The most significant player globally is Kazatomprom. Based in Kazakhstan, they are the undisputed low-cost giant of global uranium supply. They produce massive volumes through in-situ recovery methods, which are incredibly cost-effective. However, their geographic location places them in a complex logistical and geopolitical sphere, particularly when transporting material to Western utilities.
Then you have the developer class. Companies like NexGen and Denison mines are notable developers holding world-class, high-grade assets, particularly in the Athabasca Basin right alongside Cameco. These companies represent the future of supply and are critical to closing the long-term structural deficit. But they are still in the development, permitting, and construction phases.
This highlights Cameco's distinct edge. Cameco offers immediate, producing Western supply security. They do not have the geopolitical overhang of Central Asian logistics, and they do not have the multi-year permitting and construction risks of the pure developers. When you combine that immediate Tier 1 Western production profile with the vertical Westinghouse moat stretching from the mine all the way to the reactor technology, they occupy a uniquely defensible position in the competitive landscape.
But as we do in every episode, we have to look at the other side of the trade. The risks here are substantial and must be acknowledged honestly. First and foremost, uranium is a commodity. It is inherently cyclical and fundamentally price-driven. While Cameco has the Westinghouse business and long-term contracts to smooth out cash flows, their ultimate valuation is tethered to the global price of a physical rock. If the commodity price stalls or drops, the equity will suffer, regardless of the broader AI narrative.
Furthermore, there is a timeline mismatch. Much of the AI-driven nuclear demand, particularly the new reactor builds and the deployment of small modular reactors, is a 2028 and beyond realization story. It takes years to build these facilities. In the near term, if the broader artificial intelligence-powered trade cools off, or if data center build-out timelines get pushed to the right, this stock can be highly volatile. You are dealing with long lead time infrastructure, which means sentiment can swing wildly in the interim.
We also have to acknowledge the valuation and the operational realities. The valuation is not obviously cheap right now, largely because the market has already priced in a significant portion of the nuclear renaissance, and mining is notoriously difficult. There is constant operational and mining risk, water inflows, grade variability, labor negotiations, and regulatory hurdles. Finally, from a technical perspective, the stock currently trades below both its major moving averages. By that measure, it is still in a defined downtrend, reflecting the recent cooling of the broader uranium commodity complex.
Looking at the chart as of early July, we can map the current technical landscape, carefully framed. The stock is deeply oversold, sitting well off its recent high and trading below both its 50-day and 200-day moving averages. On the downside, the immediate level to watch is the recent low, which acts as the first potential area of support.
On the upside, those two moving averages, the 50-day and the 200-day, are the immediate overhead hurdles that would need to be reclaimed to signal a shift in momentum. Beyond those, you have the prior high sitting well above current levels. But we must include a crucial caveat here, more so than in previous episodes. Because Cameco is fundamentally tied to a commodity, the standard valuation model is genuinely lower confidence. It is entirely price-driven by the underlying uranium market.
Therefore, you have to lean heavily on the fundamental supply and demand story and the technical levels, rather than anchoring to a precise equity price target. A sudden shift in the spot price of uranium will instantly overwrite any static valuation model. These are levels that move. And what you do with this map is entirely your call. We do not hold positions, we are not telling you to buy, and we are not telling you to avoid it. We are simply laying out the architecture of where the stock is operating today.
Let us sum this up and distill the entire complex dynamic into the one-line thesis. You simply cannot run a nuclear reactor without fuel, and the Western world is structurally short of it.
Cameco is a long-runway fuel supply core holding an entirely unique position in the market. With its Tier 1 Canadian production and its vertical, mine-to-reactor moat through Westinghouse, it offers a level of Western energy security and technological integration that almost no one else in the industry can match.
That wraps our deep dive into the nuclear bottleneck of the AI power chain. To reiterate the core thesis, Cameco stands as the essential long-runway fuel supply core with an unparalleled mine-to-reactor moat, sitting right at the base of the clean energy transition.
As always, the levels and the framework we discussed today are just a read on the current landscape. The analysis is for your own research, and it is not financial advice. Next time, we are moving to Episode 7, the grand finale of this chain. We will be looking at Freeport-McMoRan and the ultimate metal of electrification, copper. Thank you for joining us on The Working Thesis, and we will see you in the next episode. That's a wrap for today. Thanks for thinking it through with us. We're just testing our theses out loud, one day at a time.
Catch you on the next one. Stay curious and tell us where we're wrong.